All right, good morning, everyone. It is 8:38 on the morning of March 6th, 2023, and this is my pre-market strategy session. So, the title of today's video is "The Market Can Behave Irrationally Longer Than I Can Remain Liquid." And basically what that means is I can be wrong with the direction of the market, so much so that it'll cause me to go broke or actually not have any trading capital left. Longer, that I'll go broke before, the market behaves in a way that I expect it to behave. If, I'm leveraged or trading or so on in the wrong direction, right? And it is my belief that this bear market rally this is somewhat of I don't want to call it a blow off top, because we're not going to, I seriously doubt we're going to make a new top on this run, on this bear market rally right here. But I think that it's going to be long enough to pull people in, to get people, a lot of traders and retail investors on the long side. It's going to rise enough to make to cause to ready up for what's called a liquidity event. And so I don't know what that liquidity event is. I mean, there are plenty of things out there. I mean, sovereign debt, the Ukraine mess that's happening, the possibility of an escalation in tactics being used, which would be just devastating. I mean, I have faith in humanity, maybe falsely so, but I'd like to think that humanity won't go the route that it looks like it's going at the time. But anyway, this is just, in my opinion, this is a down move that just prepped up for the next up move in this bear market rally. So here I have a Fibonacci, and I've placed that Fibonacci on the recent low put in here in December of last year, the very end of last year, and then up until it was the beginning of February of this year. And so, here's the 50% line at 286.89, and there's a nice break up above it right here, right? And then a push, real strong push over the next just a little bit over a week right there. I believe this is something like a 20% move. Let me measure it again here real quick. 20.6% move from bottom to top, from the 28th of December to the 2nd of February. So now, we've experienced some pullback here, and the selling has gotten tired. And so now it is my opinion that we are going to go up and certainly challenge this 313 number relatively soon. If we break and hold 313, we pop up above it, retest, maybe spend a little bit of time there, and then go to the upside. These are the cues. Then we are headed to this 346 number on the cues. And that can happen over the course of, say, the next 6 months or so. Wow. And if that happens, if we run up here to that 346 number, say we pull back for a little bit, bobble around, and then burst through again, the next target on my chart is 400, and that's going to challenge the all-time highs. But it's my belief that we fail this bull market rally, this bear market rally will fail prior to making new all-time highs. So 400 is a bit of a stretch. I mean, that's pretty high up there, especially from where we are right now, just over 300. Entirely possible though. And what it's setting up for is this monster. This is a 2-year, 10-year right here. And actually, we're making new all-time lows. Look at that. Bond market opens up at 830. And it opened up, the 2-year was yielding 954 more basis points than the 10-year as of the open of the bond market this morning. That's a new, with respect to the time frame of the data available to me in this chart, which goes back to the early 80s or late 80s. So that, what is that? That's nearly almost 40 years, almost 35 years worth of data, and that's a new all-time low according to this chart. Now I think there's a little bit more data that's shows that it's a little bit lower, maybe around 87 or so, something like that. But according to this chart, according to at least the last 35 years, here we are making new all-time lows on the 10-year, 2-year spread. And previously, in previous crashes, it's not until the yield curve normalizes again that we really start to see the crash. The tops in the markets happen about 2 months, roughly 8 weeks or so, 6 to 8 weeks before the crash occurred. So this blue line denotes the big downturn in the equity markets. But about 2 months prior to this is January of 2001. Prior to January of 2001, about a couple of months, and I haven't looked at it in a while, but a couple of months prior to January of 2001, the Qs topped out. So we saw the top. I'm just going to kind of wing it here. We saw the top in November, then we saw the crash in January. The housing bubble. The yield curve actually inverted, came back up above, and then stayed inverted for a long time. And then about 2 months before the crash occurred in June of 2007, that's when the crash started, we saw the top in the Qs around April of 2007. Yeah, I'll go back today and look at that data and mark off where the tops were in the markets. And so here we go, fast forward. Right there at the end of 2019 going into 2020, we were headed into some rather severe economic conditions. And believe it or not, even with the COVID crash that caused the close down crash that that the market witnessed, it actually saved a lot of people's butts. That COVID crash was extremely predictable. I know that I was keeping an eye on the possibility of a lockdown, and I definitely got out of, I got into a large cash position, and then as February of 2020 leaked on, I'd gotten myself into a rather significant position on the VIX, specifically the TVIX, which I think stopped trading for a while. I did a pretty decent job of certainly hedging the portfolio movement to the downside, and made a little bit more on top of that. And so here we are, right? So these two green circles right here, they kind of denote a yield curve inversion, but it was cut short because of the Fed dropping rates, and then also Congress passing a stimulus package and PPP and all this other crazy stuff. So here we are right now. We are we could go as far back as March of 2022 with the yield curve inversion, because technically it did close in the negative. But I'm going to just go ahead and say from June 2022 is when the yield curve inversion really started, just when it stuck. So 1, 2, 3, 4, 5, 6, 7, 8, 9. We're 10 months into this yield curve inversion. And historically here you can see this is prior to the 92. 92 was a crash, a bit of a crash, but it also is rather measured, but a crash nonetheless. So this yield curve inversion lasted for about 18 months. Then this yield curve inversion for 2001 lasted about 12 months, and then the housing bubble lasted for about 18 months. The yield curve inversion did. So here we are 10 months into it. We're just heading into 10 months again. Let me count again. 1, 2, 3, 4, 5, 6, 7, 8, 9. Yeah, so March marks month number 10 on this yield curve inversion. And so if you figure, the yield curve inversion will last anywhere between, historically speaking, 12 and 18 months, that means we're somewhere around 2 to 8 months away from the yield curve normalizing again, the 10-2 normalizing again, and then once it pulls back up above zero, it'll probably accelerate and cause a major downturn in the equity markets. And that is what this bear market rally is setting everyone up for. This is going to be, there's a scene in the movie, what do you call it? What is it? Pearl Harbor with Ben Affleck and a few other really quite major stars, quite a few. In fact, Sizemore, actually, the guy that played one of the sergeants, the actor that played one of the sergeants, so apparently he passed away recently, quite young, in his 60s, I believe, from an aneurysm. God bless him, rest in peace. But in that movie, there's a scene where one of the airmen takes a defensive position behind some sandbags, and the defensive position was placed right next to what looked like enormous propane tanks. And one of these aerial bombs drops and bounces along to where that defensive position was. There's a machine gun, and the character's name was Billy, right? And so the bomb, bops around and ends up sort of in his sandbag position next to those giant propane tanks. And it stops, and so Billy's like, "Oh, hey, it's a dud, it's a dud." And of course, then you see the sort of the spinning, whatever mechanism it was, it stops, and however that works, I don't know, but it appears to have been the detonation mechanism, that was then triggered once that little propeller stops, and ba-boom, Billy's defensive position gets blown up with that rather large bomb and the propane tanks, right behind them. I don't know who would ever set up a defensive position behind propane tanks. That's probably Hollywood for you. So anyway, there will come a point where the market rallies high enough to get all the Billies to come out and say it's a dud, and then kaboom, something's going to blow up. This yield curve is going to normalize. Something's going to blow up, and there's going to be some kind of an enormous downturn. Now, does that enormous downturn result in new lower lows? Does it stop before it makes the new lows? I don't know. I have no idea. But there is something on the horizon. There is something on the way, and so this is, in my opinion, what is going to end up being a sucker's rally on the markets. So gold is shaping up, and this move right here in gold, impressive as it was, or as impressive as it is a sucker's rally. An environment where rates are rising and inflation is falling is not conducive to higher gold prices. And it is my opinion that gold prices will roll over again in the same fashion that it rose up here to this. This is a distribution pattern, if I've ever seen one. And it's just going to start leaking off back down again, back into somewhat of its more normal historical prices. Let's look at natural gas real quick. So where is that? It's metals. Let me go. That's Bitcoin. All right, let me go to risk range plays here. Natural gas. Yep. So natural gas now, right now, here's the distribution pattern. It's very similar to what gold has done. Then there was somewhat of a sucker's rally right here, right? Dip down, everything's gonna be all right. No. Economic conditions where rates are rising and inflation is falling, is not good for commodities. And natural gas, in my opinion, is going to head back down and stay back down here around historical lows for a considerable amount of time. And gold is doing the same exact thing here. Let me get over to gold. Let me go over here real quick to risk range plays. And so it's gonna, gold is just sort of in this portion right here. You can see the similarity here. Like gold is here right now. And it's headed down just like natural gas is, in my opinion. Once whatever the yield curve, the bond market always gets it right. So whatever the yield curve inversion is predicting, whatever kind of mass mayhem and chaos is in front of us with this, I don't know. I mean, there are a dozen things to point at, and there are a bunch of things to point at to kind of be really, really bearish on the equity markets. Plenty of stuff out there, to really cause people to start selling and go into cash and so on and so on. But for right now, the selling is done. The bear market rally, again, it's going to be a bear market rally. Eventually this thing rolls over again and comes back down. But until then, until we figure out what it is, if it's some kind of sovereign debt issue, emerging markets debt issue, God forbid, if it's war, if it's another housing bubble, if it's who knows? I kind of doubt that the auto market right now. The auto market is in bad shape. Apparently, dealers are having a really hard time selling cars right now. I don't think that's really going to be that. Might be a contributing factor, maybe in whatever's coming. I have no idea what it is, but it's coming. In the meantime, though. Like I said, the market can behave irrationally longer than I can remain liquid. So bullish is the correct direction, in my opinion, to be in, and looking for opportunities to the long side here. We're coming out of overbought in the pre-market on the Qs on the 1 minute, and looks like we're going to dip out of overbought possibly at the open here on the Qs. Let's take a look at the VIX. That's the natural gas I was looking for. So the VIX is working on coming out of oversold. So opening bell conditions are looking a little bit short-term bearish, like say the first hour or so of trading. After that, though, if these relative strength index indicators are coming out of oversold, hang on a second. There's somebody at my door. I'll be right back. All right, sorry about that. So there's some construction going on in the street outside of my office, so I've got to go and move my car. All right, so there's something on the way, but in the meantime, until whatever that is reveals itself, it's the market can behave irrationally longer than I can remain liquid. So just get with the program. It's bullish. All right, everybody. Good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell, and I will see you at tomorrow morning's strategy session. I am out.